Here's a summary of the Alibaba BBA stock analysis, focusing on key findings, SWOT, investment thesis, risks, and author opinions, designed for easy reading aloud. Alibaba Group Holding Limited, or Alibaba, is a multifaceted company undergoing a significant strategic transformation. The company is pivoting towards an AI-driven and user-first approach marked by a substantial capital reallocation. Key financial metrics and segment performance. China commerce, the financial backbone, but growth has slowed to a modest 3% year-over-year in FY25, with very limited adjusted EBITDA growth, indicating maturity and strong competitive headwinds. International commerce, a key growth engine, with retail revenue up 33% year-over-year in FY25, primarily driven by AliExpress and Trendyol. However, this segment is experiencing widened losses due to aggressive global expansion. Cloud Intelligence Group, positioned as the future core. Revenue grew 18% in Q1 FY25, with AI workloads seeing triple-digit growth for 7 consecutive quarters. Adjusted EBITDA surged 69% in Q2 FY25, signaling a path to profitability. Alibaba plans to invest over $53 billion in AI and cloud infrastructure over the next 3 years. Cainiao, logistics revenue is growing, but profitability is volatile due to heavy investments in cross-border infrastructure. Overall financials, FY25 revenue was up 6% to 996.3 billion renminbi. While headline net income surged, this was largely due to non-operational items. Adjusted EBITDA showed more modest growth of 3 to 4%. Free cash flow has seen a significant decrease due to heavy capital expenditures. Despite this, Alibaba maintains a strong balance sheet with over $50 billion in net cash. Strengths: ecosystem depth, a powerful and synergistic ecosystem across commerce, logistics, cloud, and advertising, creating strong network effects and high switching costs. Data advantage: generates vast amounts of data that fuel personalization and targeted advertising. Scale and cost advantages, particularly in cloud, enabling aggressive pricing strategies. Intangible assets, brand trust and proprietary algorithms, with the Quint LLM being a significant new addition. Vertical integration, synergies between commerce, logistics, cloud, and ads are difficult to replicate. Weaknesses: erosion of core e-commerce dominance, facing increasing competition from Pinduoduo on price and Douyin/Kuaishou through content commerce, leading to market share decline and margin compression. Complexity and governance costs: managing a sprawling ecosystem leads to operational challenges and rising service complaints. Shift in consumer behavior: the move away from traditional search-based commerce to content-driven platforms is a direct threat. Cash burn: significant capital expenditures in AI and cloud infrastructure are impacting free cash flow. Opportunities: AI and cloud leadership, leveraging massive investments in AI and cloud to become China's leading technology infrastructure provider. International expansion: growing the international digital commerce group into a profitable and scalable business. Deepening consumer lock-in: enhancing loyalty programs to integrate core commerce with everyday services. Technological self-sufficiency: developing proprietary chips to mitigate geopolitical risks. Threats: intensifying competition, price wars with PDD, and the rise of content commerce from Douyin pose significant challenges. Geopolitical risks: U.S.-China tensions and export controls on semiconductors impact AI ambitions. Regulatory scrutiny: ongoing risks of future regulatory intervention in China and uncertainties surrounding the VIE structure. Rapid technological change: the risk of being outpaced by more agile competitors in the fast-evolving AI landscape. Main investment thesis: The core investment thesis centers on the success of Alibaba's AI and cloud pivot, aiming to create a new, high-margin growth engine and defensible moat. A secondary thesis is the success of its international expansion, turning the International Digital Commerce Group into a profitable venture. Finally, the moat defense holding suggests that Alibaba's pivot to a value-based, consumer-centric moat will successfully counter competitive threats. Significant risk factors: core e-commerce decline, the possibility of accelerating market share erosion, and continued margin compression in its core business due to competition. Cash burn versus monetization, the risk that massive investments in AI, cloud, and logistics might not generate commensurate returns, leading to sustained negative free cash flow. Geopolitical and regulatory intensification, escalating U.S.-China tensions, new Chinese regulations, or challenges to the VIE structure could severely hinder operations and valuation. Notable statements or opinions from the author. The author highlights that Alibaba's financial performance reflects a calculated, high-risk bet on a new growth narrative. They note that the market's valuation reflects uncertainty, as investors are not yet convinced that the long-term payoff will justify the short-term margin compression and SCF decline. A key strategic maneuver discussed is the open sourcing of models like Quinn, which is seen as a way to bypass monetization challenges and foster a developer community, creating a technology flywheel and a sophisticated and defensible moat. The analysis also emphasizes that Alibaba is aggressively building a more subtle, value creation-based lock-in on the consumer side, a pivot from previous coercive strategies. In essence, Alibaba is navigating a challenging transition, betting heavily on AI and cloud to redefine its future, while battling fierce competition in its established e-commerce dominance.